A partnership is a voluntary association of two or more individuals who have a business for profit. A partnership does not need to be only two partners. There can be more than two, but partnership cannot be one person. Compared to corporations, partnerships are easier to form. Not as easy as a sole proprietorship, but still easier than corporations. I have a link here that I'm going to show you. This webpage is from the state of New Jersey. It explains how to register and start your business. If you want to form a partnership, you can just follow the directions on here. And like I said, one of the advantages is that it is easier to form than a corporation. Every partnership should have a partnership agreement. This is something you might learn in a business law class. This would be a contract stating everything that the partner should know when beginning the business. It covers topics such as dividing income, how to settle disputes, what to do in case of a liquidation. And I do have another link here to show you, which is a template of what a partnership agreement can look like. This is a template from lawdepot.com. You would list the different parties, information such as the name of the business, the purpose, place of business, capital that's going to be contributed to the business, which is something we're going to talk about in a little bit. How to withdraw capital, basically withdraw money from the business. Terms on how to add new capital, interest, what to do for a profit and loss, annual reports, the fiscal year, auditing it, management, meetings, how to admit a new partner or withdraw a partner, and we will discuss this as well. And if you go through this, you'll see that there's a lot of information here. Dissolution of a partnership, this is the termination or liquidation of it, which we will also discuss. This is just a sample. You can have whatever you want in the contract, but it should be very extensive. And I do recommend seeing a lawyer to help you make one if you do decide to open up a partnership. When you form a partnership, all property is co-owned by all the different partners. For example, if I contribute my printer to the business, that is no longer my printer. It is now owned by all the partners. The assets in the company are co-owned by the business, by all partners. Another topic to be mindful of is the taxation for a partnership. A partnership is considered a flow-through entity. A flow-through entity means that all the income from the partnership will be passed through the partnership to the owners. If my partnership made $1 million this year, the partners will receive that money, and then the partners will have to pay those taxes on their tax return. The partnership does need to file a tax return, but does not pay any of the taxes. The tax return will show how much money the partnership made and what each partner's share of that income is. This is an example of a tax return for a partnership. It's very similar to an income statement. This first section will list the income of the partnership, and the second section will be the expenses or the deduction in order to determine net income. Then that income will be reported for each of the different partners. This is a Schedule K1. A K1, think of like a W-2, where you would get that from your employer each year. Partners will get a K1, which will show their income of the business. You don't need to know how to fill this out or anything. I just want you to be aware that the partnership does not pay taxes. The tax return will show how much money is made. And then a K1 will be given to the partners, and the partners will have to put that income on their tax returns. Partnerships have to be mindful of government regulations. This is still considered an advantage over forming a corporation. The government regulations for partnerships are a lot easier to follow than it would be for a corporation. A concept that's considered a disadvantage for a partnership is called mutual agency. We did briefly discuss this in another chapter. I'm not sure if you remember or not, but mutual agency means that each partner can act as an agent for the business separately and independently. Meaning if I have a partnership with someone, my partner can go out and sign loans, sign deals, get into contracts without me being present. It's considered a disadvantage because they can act beyond their authority. Another one of the disadvantages would be unlimited liability. This is a disadvantage over a corporation. A corporation has limited liability, if you can remember. This means that if I invest in a business that goes under, I might lose my investment, but that's it. My personal assets are protected. Unfortunately, for a partnership, it works the same way as a sole proprietorship. Whereas if the business goes under and we get sued or we owe all this money to our creditors, my personal assets would be at stake. This is what unlimited liability means. The liability for the business is unlimited. It's not just limited to the business, but it's unlimited, meaning my personal stuff is at stake. Another disadvantage is that a partnership does have limited life, similar to a sole proprietorship, but different from a corporation. A corporation has unlimited life, meaning if the owner passes away, the company can still continue going forward. Whereas with a partnership, limited life, usually when something happens to one of the partners, they do need to dissolve the business. Now, the partnership agreement can state otherwise, but just for boilerplate normal talk, that the partnership does have to dissolve, and then any remaining partners would have to start a new one. Next, we'll discuss the different partnership types, because you don't have to have just a regular partnership. There are a few different options you have depending on the type of business you have and the relationship you have with the other partners. Most of our examples are going to really just be a general partnership, but it's still good to know what the other types are. A general partnership, basically meaning everyone runs the business, all partners are involved, they all have the same responsibility for the partnership, for their debts, and for all the obligations in the partnership. Another type they can open is called an LP, a limited partnership. This is when there are general partners and limited partners. The general partners, I always say, think of like a general manager. A general partner is the ones who run the business, the day-to-day operations. They're the ones who are involved. They will have unlimited liability for the partnership debts. On the other hand, a limited partner, they are not involved with running the business. They're basically like investors. They will have a limited liability. That's why it's called a limited partner, because they have limited liability. Meaning if the partnership goes under, they might lose their investment, but their personal assets are safe. An example of this could be if one of you students has a great business idea and you need an investment, and I say, okay, here's some money, I believe in you, go start this business. And then you go and you run the business, and all I am is an investor. I have no say in the operations of the business. You're the one who's running it on a day-to-day basis. In the end, if something happens, you'll be the one who has personal assets at stake, at risk, where mine would be safe because I'm not the one running the business. Another form would be an LLP, a limited liability partnership. This is mostly for professional businesses where each of the partners has their own certification and pretty much practices their profession separately. For example, an accountant's office or a lawyer's office, a lot of doctors and dentists are set up this way. For example, when I go to see my doctor, there are multiple doctors in the office seeing their own clients, yet they share the space, they share the office expenses, they share the receptionist, yet they're all practicing separately with their own clients. If one of those partners gets sued for malpractice, the other partners are not at risk. That does not mean that they're not responsible for the debt of the partnership, but any malpractice claims would be only on that one specific partner. This last type is not a type of partnership. It's a hybrid between a partnership and a corporation. It's an LLC, a limited liability company. Members have the same limited liability as a corporation. That's one of the main advantages of a corporation, but it also has a limited life like a partnership. We're really not going to be discussing this one at all during this chapter because it's not a true partnership. Like I said, it's a hybrid between a partnership and a corporation. All the examples that we're going to be doing going forward, we're only going to be dealing with general partnerships.